Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. If you go back and read the backstory of legendary traders, you'll notice something. A lot of the biggest names weren't stock traders. They were essentially commodities traders. Richard Dennis seems to have borrowed $1,600 from his family in 1970 and spent most of it buying a seat at the Mid-America Commodity Exchange and traded what was left into a fortune reported to be in hundreds of millions. Soybeans, corn, gold, they called him the Prince of the Pit. Bruce Kavanaugh took a $3,000 cash advance on his MasterCard in 1977 while driving a taxi in New York. A soybean shortage ran his position up to around $45,000 in just 6 weeks. Then the market turned and he gave back roughly half of it in a single hour. But these were American traders operating in American markets, which are deep, liquid, wide, with decades of continuous data behind them. India is a different animal. Our commodity markets exist and they work, but liquidity sits in a handful of contracts, and outside of that, things get really thin. So that got me thinking, if I were to trade commodities in India, where do I start? And more importantly, are there any unique characteristics of these commodities from a trading standpoint? In other words, do Indian commodity futures actually trend, or do they mean revert? Because the answer to that question decides a lot downstream, whether you are a trend trader or a mean reversion trader. And if you picked up a strategy from an American trading book, whether it really applies over here. To answer that, you need a basic sense of the products themselves. So what I did was I took 5 most liquid commodity futures in India and ran a baseline test on each of them to see how they behave. Do they trend or do they mean revert? So without further ado, let's get started. Before I start, here's the disclaimer. The examples and ideas shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in stocks and derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. If you are new to the concept of trend versus mean reversion, you may want to watch this video before you get started. So here's exactly what I did. I took 5 most liquid commodity futures on MCX. Gold, silver, copper, crude oil and natural gas. 2 precious metals, 1 industrial metal or base metal, and 2 from the energy basket. All futures. The price series is back adjusted, meaning a continuous series stitched together across rollovers rather than a single expiry. The backtest period is 11 years. On each of them, I ran a very simple backtest using Super Trend as the indicator on the daily time frame, with the default 10-3 parameters applied on close. The design is a stop and reverse system, which means you are always in the market. When this indicator flips, you don't just exit, you exit and take the opposite position. Long becomes short and short becomes long, and you keep flipping for 11 years. The stop and reverse trend system is an honest test of whether a market trends. If prices move in sustained legs, the system stays with them. If prices chops and revert, it gets whipsawed on every flip. Either way, the log will tell you. And that's what we analyze. The trade log with the long side and the short side looked at separately because the two don't always behave the same way. One disclaimer before we go any further. This is not a trading strategy and I am not recommending it. There are no costs, no slippages, no rollover impact built in, and post-cost it may well not work at all. The purpose here is very specific. It is to get a sense of how these 5 products actually behave from a price perspective. Let's start our analysis by looking at the directional skew of the trend for each of the commodities. To do that, we'll ask a very simple and fundamental question to start with. That is, how many days do the long trends occupy and how many days do the short trends occupy? As you can see in the chart, when we look at gold has a slight long skew. It spends 140 days more on the long side. Silver, on the other hand, and all others have a slightly short skew, which means they spend more time on the short side. Crude oil is right in the middle because it spends an equal amount of time on both sides. We'll come back to it later, but there's something worth observing there. The net change points are from the start of the data to the end. How many points did this particular series capture? Sort of a buy and hold reference. Next, let's look at the number of points captured over the 11 years on each side by each of these commodities. So what you essentially see is that for gold, most of it was made on the long side. The short side lost money. For silver, both sides worked. For copper again, both sides worked. Crude seems to have an upward bias where long worked but shorts failed badly. Natural gas, as you can see, only shorts worked. So the lesson from this chart is that saying that a commodity is trending doesn't mean much. You need to ask which side does it take. So essentially what I'm trying to say is some commodities can trend in one direction only, and therefore the side that you take matters. So far what we have is the directional bias in terms of the trend that each product has. But let's also look at how sustained trends are in the given direction where it succeeds. So in the next chart we will look only at the winning direction. What that means is if it's gold, we look only at the long side. If it's silver, we will look at both the sides. If it's copper, again, we will look at both the sides and so on. Let's start with the win rate, which is one of the most intuitive parameters to understand. So as you can see, gold long wins almost 49%, followed by crude long and then silver short and so on. The next is the payoff, which is the average win divided by average loss in absolute terms. Higher the number, the better. And lastly, we have the return to max drawdown, which is how much return do you get for the drawdown pain you experience. As you can see, gold has a clear edge on the long side, and that's quite visible, so does silver. Copper again has an edge on the long side, while crude may have a slight long bias, but it's a bit of a neither there nor here kind of a thing. Again, as you can see, natural gas seems to have a minor skew on the downside. While these are skews, not everything is tradable. You really need a decent payoff and a sustainable return to max drawdown number, and I don't have to tell you which ones got those. Now the next question we are asking is which of the products have a mean reverting nature? One way to answer that is, what if we take the opposite trade? So this chart answers that question. Not whether a given commodity trends, but whether there was any side in any product where doing the exact opposite of the signal would have paid you. Now across the 5 commodities and 11 years, there are only 3. Now I know quantitatively speaking, this is not a perfect way to figure if a product is more mean reverting, but to keep things simple, I'm using this as a measure. Any other statistical test to measure the mean reverting nature of this time series would have complicated it for many. Let's start with gold again, the gold short signals that is. Fading them returns 331 points, which is another way of saying that shorting gold did not work. 46 short signals in 11 years and you would have been better off taking the other side of everyone. The second is the crude's short signal were 2,652 points. The third is natural gas's long signals were 245 points. While both are positive, but you should dig deeper to figure out whether there's really an edge before getting too excited. So far we've got some sense of individual trends or lack of it in any given direction across these products. Now before we take any other decision, we need to understand another aspect, that is consistency across years. For example, when we say gold has made money, we'll see how many years out of the past 11 years has it made money. Likewise for other commodities and their winning directions. The answer is clear. Gold long wins hands down, followed by copper long, and natural gas short trade comes third. If you are looking for consistency, which we all should, we know where the answers are. While the other numbers look good on silver, the moment we look at it from a year-wise consistency standpoint, things don't look good at all. There's one more last view worth taking before you form a sense of how these commodities work. And that's which years actually did the work. Look at silver's short side. 2026 alone has paid more than the entire 11 years combined, and that's only 5 months of it. Copper long side is much the same, most of it arriving this year. Is there a copper supercycle running? Worth asking. Crude's long side tells a different story. It worked in 2020, 2021, 2022 and 2023. 4 years in a row, which looks like a macro trend at play. Now, this is another view which you may want to include in your analysis before forming a sense of how these commodities work. So that brings us to the end of this episode on comparing MCX commodities to see which of them trend and which of them mean revert. As I said earlier, treat this as a starting point, a baseline test, not a strategy. It's just meant to give you a broad sense of how these products behave in India and nothing more than that. It also points somewhere else. The drifts that you have seen aren't some sort of accidents. There are valid macro reasons why some commodities have a positive drift, others a negative one, and why some hold their direction better than others. Those reasons are beyond the scope of this video, but they aren't hidden. If you go looking at supply cycles, at storage cost, currency effects, you will find the patterns and the reasons behind these patterns yourself. With that, I hope you found this episode useful, and if you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.